Welcome to The Truth About Real Estate. I'm Erin Blaze, and in my career as a realtor, many times people have asked me if home ownership will help them save money on their taxes. So today, my special guest is Steve Shirey. He's a CPA with over 30 years of experience, and he's going to answer some questions about that. Thanks for coming on the show.
Thank you, Erin.
The first thing I wanted to ask you about is when someone buys their first home because they don't know whether they're going to be able to get a tax deduction on buying their first home or not.
Well, one of the things that's important for people to remember is that taxes shouldn't be your first consideration in making life decisions, but in general you will save money in taxes by owning a home. You get to deduct the points when you buy your home if it's a personal residence. You get to deduct property taxes. You get to deduct the interest on that home. But what happens is when you put your income tax return together, your itemized deductions are what accumulates all the things that you get to deduct, like your interest and your taxes and your state income tax and charitable contributions. All those things have to be larger than your standard deduction in order for you to actually save money by buying a home.
Okay, could you explain what the standard deduction is?
The standard deduction is an amount that the IRS gives everybody, whether you own a home or not. It goes up a little bit every year. It's sort of indexed to inflation. It's more if you're filing jointly than if you're single. Currently it's around $11,000, but it keeps going up.
I see, so it would be possible that some people would not get any deduction from buying a home.
That's correct. A person that buys a modest home, puts a lot of money down, they may not have enough itemized deductions to overcome the standard deduction.
Okay.
But they'll still come out ahead over the long term because most of the time a personal residence, if you take care of it, keep it fixed up, it will appreciate in value.
Okay. And so what about, I guess one thing I wanted to ask you about was the capital gains tax, because I told my husband he was not going to be able to get an exemption on his capital gains tax because he only lived in his house for a year after he bought it, and then he moved out and rented it. How does that work?
Well, you have to live in your personal residence 2 out of the past 5 years in order to be able to claim the exemption from the capital gains. But you know, you got 5 years and you only one of the parties has to live in the house for 2 years. So like if you're married and you sell your house and the two of you move back into his house for a year within that 5 years, then you sell it, you're good to go.
Okay, well I don't think he'd be willing to do that. But do you still have to pay all the capital gains?
No, there is a phased-in exemption if you have less than 2 years. And it's going to depend on when you sell it, how much your gain is. And there are several other ways around paying the capital gains on that. You can exchange the house. Just a number of ways to work it.
Okay.
Planning is always a good thing.
Okay, well how would it work if he decided that he was going to do an exchange and just buy another nicer rental property, for example?
Okay, once you convert a personal residence into a rental, then you are in a whole different market and a whole different set of tax circumstances. Because when it's a rental, you get to deduct the interest and the depreciation, which is an estimate of the cost of the house amortized over a statutory 27.5-year period for residential real estate. So if you sell a piece of rental property, you would have a rather lengthy computation to determine what your actual gain is that could be taxable. If you want to exchange it, there is a provision called a Starker exchange, obviously named after a man named Starker, but you would identify a replacement property within a certain period after you close on the sale of the home, and you have to close on the purchase of the replacement home in that same time period. And when you do that, you don't pay any tax on the gain of the house that you sold. And you could actually, in some cases, work a direct exchange rather than a Starker exchange. For example, if somebody has a duplex or a piece of land and they want a rental house, you can make an exchange in that way. It doesn't have to be, you know, like a 3-bedroom brick ranch for a 3-bedroom brick ranch. A piece of real estate is a piece of real estate.
Okay, well, if somebody wants to do the Starker exchange, I think one thing people are confused about is, do you have to set this up ahead of time?
Oh, yes.
Okay.
It's something that you have to identify at the time you list the property or set the property up on the market for sale, because of the time schedule you have to meet for the replacement residence. You have to, you know, you could get lucky and sell your house and then decide at the time you sell it that you want to work a Starker exchange. You have to have a third party involved because you can't receive the money from the sale of the residence. Once you receive that money in your hands or under your control, then you have the gain and you have to pay tax on it.
I see. So you can't just say, well, I'm going to exchange this and I'll take $5,000 out and I'll put the rest in the exchange.
You can do that, but you would pay tax on that portion of the gain that that $5,000 represents.
Okay, that's very interesting.
Yeah.
Okay. What about when someone buys, for example, a second home? I would love to have a condo on the beach, but I probably wouldn't spend very much time there. Would I still get some kind of a tax deduction or tax benefit from owning that?
Oh, yes, yes. Most congressmen have a home in Washington, D.C., and they have a home in their the area that they represent back home, the people that elected them. And Congress allows what Congress understands. So most people can have 2 personal residences. So you could have your personal residence here in Columbia, and you could have your condo on the beach in Puerto Vallarta, and you could deduct interest and taxes on both of them.
That's a great idea. Could I still rent out the condo that's the second home for part of the time, or would I have to keep it open just for me?
That gets interesting because you have 2 sides of that equation to worry about. You can rent it out for up to 14 days and not have to pay tax on the rental. If you rent it out most of the year, you have another limitation for personal use. So you really have to decide which one you want to do. And talking with your tax advisor in advance is always preferable to coming up at the end of the year and saying, oh, by the way, I did this. I rented out for half the year. I lived in it half the year. What can you do for me? Well, they can do a lot more for you if you talk about it in advance.
Okay. And so what about the case, like here in Columbia, we have a lot of parents who will buy a home here and then have their kids in it, and maybe they live in St. Louis or Kansas City. Does that still count as the parent's second home?
If they only have the one home, they could potentially do that if only their kids live there. But
so it doesn't work when they have roommates?
If they have roommates that pay rent, they have a rental property, and then they have to get into depreciation and all that.
Okay, all right. Very interesting. I was curious about that because lots of people do that here.
Yes.
So the trick would be that it can't be a rental property. It would have to be just for their family.
Well, it has to be one or the other. You can have a second personal residence, or you can have a rental property. It's probably not a good idea to try to do both because it gets too complicated. But even if they don't get any tax advantage out of it at all, you know, again, back to the original idea that you don't let taxes run your personal life. You know, you make your goals and you proceed toward them, and you consider taxes before you enter into a transaction. So even if they just have the house for the kids to live in so they don't have to rent dorm rooms, they're probably going to come out okay, and the house will probably appreciate.
Yeah,
So,
I have seen that in my experience, that people will buy a home for their kids, then they'll sell it after they graduate, which, you know, takes 4 or 5 years, and then they use that to pay for all their school expenses. So basically they went to school for free.
Yeah.
So that's kind of nice.
Yeah. Or if their neighbors or friends have kids that are coming up here to MU, then they can sell a house to them.
Yeah, that's true.
Start over.
Yeah. Okay. I wanted to ask you some more about the rental property. Because I've had rental property. I know lots of people have rental property. And the thing I'm wondering about is the depreciation. Is there some kind of a maximum allowable depreciation or not? Like, like if I had like 100 rental properties and I were depreciating all of them, how much of my taxable income could I offset? Is it possible to offset all of it, or is there a limit that's imposed?
It's possible to offset it. It's possible to go even farther than that. But when you have rental property, there's a rule known as the active participation rule. So if you have 100 rental properties and you hire a property manager and you go live in that beach condo, you're very limited as to the amount you can deduct. But there's also an exception for real estate professionals. If you're involved in the operation of the rental properties and you're a real estate professional as decided in the tax law, then you can deduct all of it. So the answer is always that it depends on the rest of the circumstances. But yes, you can deduct yourself all the way into a tax loss, but that doesn't do you much good. You know, all you want to do is get down to a small amount of taxes.
Right, that's true. Okay. All right, well, I guess I'm not going to do that. All right, well, what about with land? You know, there's a lot of people that own a lot of land and they have it. I know sometimes people ask me, well, how can people own all this land that's just sitting there? Do you still get deductions for land that you're not using that actually isn't producing an income? Is it still depreciated the same?
Well, you don't depreciate land.
Okay.
Land is just there. If you have improvements on the land, some of that you can amortize. Like if you build terraces and do tiling so you can farm it, then that you can amortize or expense. But basically land sits there. You can, if it's a properly identified investment, you can deduct taxes and perhaps interest. But land just doesn't do a whole lot for you in terms of operating income or expense unless you farm it. And then, you know, that's another business that you've gotten yourself into. You can rent the land out to a farmer or a cattleman, but then you're back in the rental business.
Right, okay. And so, and would it work the same if it was another type of business? Like if I owned a business that had a restaurant in it, but I just owned the building, does it depreciate like a rental house does, or is it a different type formula?
It's a different formula. Commercial buildings and manufacturing buildings, each of them has their own lifetime identified in the tax code. So a commercial building, like if you own the shell of a building, and the person that has the restaurant inside the building, they have the interior walls, the floors, the suspended ceiling, and all the equipment. They depreciate that part, and you have the building shell, which you get to depreciate. And then, of course, you get your taxes and any interest that you might have on the loan on the building. And, of course, you have to declare the rent they pay you as income.
Okay. What if you own the building and all the equipment in it? Now, does the equipment then become part of the real estate, or is that separate?
It's separate for depreciation purposes. Equipment has a relatively short life for depreciation purposes, typically 3 or 5 years. Building might have a lifetime of 50 years. Residential real estate is defined as 27 and a half years.
How did they come up with that? Do you have any idea?
Compromise.
A compromise?
Compromise, yes. It was, in the last 20 years, the lifetime for residential real estate has changed several times. 27 and a half is what they settled on the last time they changed it.
Okay. All right. Well, if you have a personal residence and you don't rent it out and you want to go to sell it, I know I always get a lot of questions about, well, I'm doing all this to the house now so I can sell it. What, if any of that, is deductible?
Okay. There's a special rule when you're preparing a house to be sold. You can deduct things like painting and wallpaper and little fix-up things that are normally part of maintenance of a house. If you do that within 60 days typically of selling the house, then that is deductible from the sale price. If you, as you own a home, if you do improvements like a new bathroom, a new kitchen, a new front porch, a screened porch, quarry tile, all that sort of thing, that adds to the basis of the house. And the basis of the house is what's your value is when you start to compute your gain. So you have this basis, which is what you paid plus all the stuff you've added onto it. That's a number, just a number, you know, rather arbitrary, but there it is. You got the sale price, which is what is on the contract, less your expenses of selling it, you know, which is your real estate commission, any other fees you might have to pay. And then that's when you get to deduct those fix-up expenses, because that's the amount that you compare to, that's the arbitrary amount you compare to the arbitrary amount that you got for your basis to determine what your taxable gain might be.
Okay.
And if it's your personal residence, you get to exclude up to $250,000 for a single person, $500,000 for a married couple.
Okay.
So long as you've lived in it 2 of the past 5 years before you sell.
Okay. So I guess in a way that helps out people who have been transferred, because if you have a house somewhere,
Yes.
you lived in it for a couple of years, you get
Yes.
transferred and you have to rent it because you can't find someone to buy it. Then you live in this next house for a couple of years, and then you know, a year later you sell both of them, then you still won't have to pay taxes on the gain, if there is any.
That's correct. That's correct.
Okay.
So long as you've lived 2 of the past 5 years in the house, yeah.
Okay. Well, one thing that happens a lot when people are selling their home, you know, most people have been fixing their home up and improving it up until the time they put it on the market, and then it'll go under contract, and before it closes, a lot of times the buyer will say, well, before I close on this house, I want you to do X, Y, Z, and they'll give you a list of things you want done to the house. Does that also become part of your basis?
That comes, well, that's typically part of your fix-up expense, which comes out of your sale price. But yes,
Okay.
it reduces the amount of gain that you would otherwise have to claim.
Okay. All right. And I wanted to also ask you about something that luckily doesn't happen very often, but people have been talking about it because it has been taking a little bit longer to sell houses. So unfortunately, a few people have let their houses go back to the bank. And a loan officer here in town told me that someone who had their house foreclosed on got something, I don't know what you call it, but they got something in the mail basically saying you're going to have to pay tax on this
Yes.
loan amount that was forgiven to you.
Yes.
So tell me what's happening. What's that all about?
The general rule is that a loan that's forgiven becomes taxable income to the amount that, you know, is actually forgiven. And that is generally defined as the amount that the lender has to write off. So if you have a $160,000 house and you let it go back to the bank because you owe $130,000, you can't sell it, and you can't make the payments, then the lender is going to send you a 1099 form, which tells, and they just sometimes pick an arbitrary number. Typically, they'll pick the loan amount, or they might say, you know, they might say the loan amount, they might say 0. But and IRS would expect you to pay taxes on the amount of the loan that's forgiven. But if you're destitute, or if you can prove that the house resold for more than the loss that the lender told you about, then they didn't actually take that loss. So you can work with it, but again, you need to start working with your tax advisor at the time you're getting foreclosed on. And you need to watch the notice that you receive from the lender. You need to be careful and respond immediately to the notice from the IRS. because you only have a certain time period that you can take care of these things.
Okay. And is it the same then with a short sale? In a short sale, it's a house that sells, but the lender actually takes less than is owed at the closing. So does that mean the seller owes taxes on that amount?
Yes, the seller would owe taxes on the amount of the loan that's forgiven, and that would be the short sale amount, the difference between the loan balance and the amount that the lender received. Yeah, so if things get worked out with Congress and the Treasury Department and they get loans rescheduled, there won't be that many foreclosures. But if that doesn't work out, there could be a whole lot of people that have that problem next year.
And is there anything that you know about it that we don't know about it? I know you work for the state. Have you heard anything about plans to help people?
Just what I read in the paper.
Just what you read in the paper?
Yes.
Okay.
It's not a done deal until Congress approves it and the president signs it.
Yep, I've been reading about that in the paper too. I mean, it'd be nice to help people, but I wonder, I just wonder what can really be done. Let's see.
Well, you've got a bunch of people that have a very strong economic interest in keeping things moving. You've got a homeowner that probably still has a job and can probably make rescheduled payments. You have a lender that would like to reset that loan from 5% to 8%, but they'd probably rather get 6% and have a continued stream of payments from the homeowner than they would reset that loan at 8%, let the homeowner get behind and then foreclose on him, because as you probably know, banks usually lose a lot of money when they foreclose on a home.
Yeah, that's true. I did some research on that, and a bank loses an average of $40,000 every time they foreclose on someone.
Okay.
So they don't want to do it.
Yes.
And so it's always a good idea for the homeowner to call if they're behind, rather than just ignoring the calls and moving out, because the lender has an interest in keeping you in that house.
Yes, and they should call as soon as things start to go downhill, rather than when they're got that one finger up above the water and the flood's coming over them. They need to react early in the game rather than late in the game.
And I know another place people can call here in town is Central Missouri Community Action. They have a helpline for people that are behind on their mortgage. I guess another CPA type question I wanted to ask you is, did you ever work for Enron?
I worked for Enron's accountants once, very early in life. I was a very young, very green accountant for Arthur Anderson and Company. And back then, they were very, very proud of themselves. Well, they were probably very, very proud of themselves right until the end, but yeah, that's where I started out.
That's interesting.
But I never got to audit Enron or any of its predecessors.
That's true.
Closest I ever got was Kansas City Power and Light.
All right. Well, that's given us a lot of information. I feel like there's probably some more things I could ask you about. I don't know. What did I forget to ask you besides about Enron?
Oh, well, we talked about pretty much everything except related party transactions.
Okay, that's a good one.
Yeah, say you've got a rental house and it's empty, and your Uncle Harry wants to rent it from you. Uncle Harry's newly and very young and very cute wife has just kicked him out and told him not to come back, and he comes to you and says, "Aaron, can I rent that old house up on Oak Street from you?" And the guy's so pathetic. You say, "Okay, all right, you can move in. I'm not doing anything with it at the moment." But when you do that, your deductions are limited because this is a related party. So you can deduct your out-of-pocket expenses, your repairs, your interest, your taxes. You don't get to depreciate it. So long as the depreciation would throw you into a loss. So yeah, you're limited on that, and it's a similar type limitation to the one you get into on a vacation rental when you have to decide whether you're going to have a rental property or a second residence. You know, it's just you got to figure out what the rules are in advance, make sure that the deal will work out for you, and then that way at the end of the year you don't get a bad surprise.
Okay. Well, that reminds me of one more thing I forgot to ask you. How does it work on new construction? If you're building something that you're going to keep as an investment, does it start depreciating from the moment that it's done being built?
It starts depreciating. The definition that you need to use is the date placed in service, and that would be typically as soon as you get the thing done, you're going to put a sign out in front and an ad in the paper to rent it out. At that point, you've placed it in service.
Okay.
Okay, but if you're trying to sell it for 3-6 months before you decide, well, this is not going to work, let's rent it out, then it's not placed in service until the time that you decide to rent it out.
Okay, well, that's a good thing to know.
Yeah, and the other thing to remember when you buy a piece of rental property, again, you don't depreciate the ground. So you buy a house for $100,000, and when you buy a house, a personal residence, you don't know how much is land, how much is building. You know, the assessor's office has a number, but you get to determine how much land and how much salvage value, because the land value and the salvage value you don't get to depreciate.
Okay.
Okay, those are your baseline figures that you depreciate down to. So you might have a $100,000 house, but that includes a $12,000 lot. And you know, realistically, I don't know what the salvage value is on a house, sometimes nothing, but
That's true.
depends on how badly your tenants tear it up, but yes.
All right. Well, I appreciate you coming on and answering our questions on how to maximize your tax deductions. I'm Erin Blaze. Thanks for watching The Truth About Real Estate.